Take a look at this chart. It shows us the performance of the US dollar index in the first 6 months of each year, going all the way back to 1968. Green bars means the dollar has strengthened in the first half of the year, and red bars means it has weakened. Now this bar, right here, represents the dollar's performance in 2025. From January 2025 to June 2025, the US dollar index has fallen by 10.7%. This marks the steepest first-half decline for the dollar since 1973. In other words, the US dollar has just had its weakest start to the year in over 5 decades. And we happen to think that the worst is yet to come for the dollar, which could have massive implications for risk assets like Bitcoin. After all, the US dollar index, also known as DXY, has historically had a strong inverse relationship with Bitcoin, meaning when the dollar falls, Bitcoin rallies. And when the dollar strengthens, Bitcoin usually struggles. For example, the dollar dropped sharply in January 2017, March 2020, and October 2022, and each of those instances coincided with a strong rally on Bitcoin. We saw the exact opposite in January 2018 and May 2021. Both times, the US dollar strengthened, and that coincided with sharp declines for Bitcoin. We can see just how strong this inverse relationship is through this chart, which shows how sensitive different financial assets are to the US dollar. Bitcoin has a sensitivity of nearly negative 1.5, meaning that over time, it has typically moved about 1.5% in the opposite direction for every 1% move in the dollar. Of course, that doesn't mean Bitcoin reacts exactly this way on a daily basis, but on longer time frames, the inverse relationship has been consistently strong. For comparison, emerging markets come in at negative 0.8, gold at negative 1, and the S&P 500 at negative 1.03. So Bitcoin has the highest inverse sensitivity to the dollar among other major asset classes, which means if the dollar continues to weaken from here, it would be a strong tailwind for Bitcoin. Weakening the dollar has become a strategic priority for the Trump administration. The goal is simple: make American goods and labor more globally competitive by lowering the value of the dollar. And we already have clear evidence of this shift starting to take place. For instance, Donald Trump has been very vocal about the need for the US Federal Reserve to cut interest rates, going as far as to call for a full 3% rate cut. Trump has been applying pressure on the current Fed chair, Jerome Powell, to ease policy. And according to recent reports, this pressure has made Powell consider resigning. Trump is set to appoint a new Fed chair by May 2026, someone far more aligned with his views on monetary policy and one willing to cut rates aggressively. Part of the reason is that Trump may actually want US interest rates to fall below global rates as a way to intentionally weaken the dollar, and we think it's very likely that Trump is going to get his way. The spread between the United States interest rate and Europe's interest rate currently sits at 2.35%. That's one of the widest short-term rate differentials we've seen in the past 25 years. We've only seen similar extremes in 2000, 2006, and in 2019. And in each of those cases, the dollar looked relatively more attractive until the Fed stepped in and started cutting rates. That shift then closed the rate gap and removed the higher yield advantage for holding dollars. Today, with this spread at historically high levels, the dollar still remains quite attractive. But with Trump already pushing for lower rates, the US dollar could be on the verge of one of its largest declines since the early 2000s. We can see exactly why by looking at something called the Real Effective Exchange Rate for the US dollar. This is an index published by the Bank for International Settlements that adjusts the dollar for inflation and compares it against a basket of global currencies. It's designed to show how expensive or cheap the US dollar is on a relative basis. And while we've seen a small decline in this chart recently, the dollar still remains historically elevated as a result of very attractive interest rates in the US. In fact, it's still trading above its 2001 peak and not far from the extreme highs we saw back in the 1980s, right before the Plaza Accord was signed in 1985 to deliberately weaken the dollar. So there is plenty of room for the dollar to decline from here. If this chart simply returned to its 50-year average, that alone would imply a 15% drop from current levels. And a move back to the lower end of the historical range would mean a decline of about 30%. Now, believe it or not, we don't think that's a crazy scenario today. And one of the clearest signals pointing in that direction comes from what is now unfolding on the US government spending front. Trump's new Big Beautiful Bill is projected to significantly increase federal spending. Spending reductions in programs like Medicaid and renewable energy have been drastically outweighed by tax cuts, which are expected to add $4.5 trillion to the deficit in the next decade. Now, government spending by itself doesn't always have a major impact on the US dollar, but what really matters is how that spending is financed. If this new wave of deficit spending is paired with political pressure to keep interest rates low, then you're effectively telling holders of US dollars that more dollars are going to be printed and that they'll be lending them out at below average returns. That combination is actually negative for the dollar and could make investors flock to other currencies. And given Trump's push for lower interest rates, alongside this increase in government spending, you could argue that even the deficit spending itself is part of his broader strategy to weaken the US dollar. While it won't be a straight line down, we do think there's still plenty of room for the US dollar to weaken further based on these recent developments. And in that kind of environment, Bitcoin may offer one of the most asymmetric opportunities. We can see that more clearly through this chart, which shows how Bitcoin has historically performed when the dollar is strong versus when it's weak. The data is broken into 5 groups, called quintiles, based on how the US dollar performs over a 6-month period. The first quintile represents the times when the dollar was the weakest. The second and third represent periods of relatively moderate weakness, and so on. And when we look at Bitcoin's returns, we can see that when the dollar was at its weakest, so in the first quintile, Bitcoin returned an average of about 250%. In the second quintile, the average gain was 124%. And even in the third quintile, where the dollar was only moderately weaker, Bitcoin still delivered an average return of 68%. So if we do see the dollar weaken from here, the historical data suggests that Bitcoin could rise another 70% to 250%, which would put it somewhere between $200,000 and $400,000 per coin. Now, of course, that's based purely on historical averages. But in our opinion, given today's fundamental setup, a $200,000 Bitcoin doesn't seem like too much of a far-fetched number. That's why we still hold an active long position on Bitcoin on our website, with our most recent entry at $107,000. We've been taking our clients step by step through this crypto bull run, sharing real-time trade setups and our trading strategy through 3 weekly premium videos. In just the past year, our crypto trades have delivered some incredible returns, including a 30% profit on Bitcoin and an 83% gain on Ethereum. We send out buy and sell alerts whenever we make any changes to our position. If you want to follow all our trades in real time, make sure to join us using the link below.